Good morning, everyone. Thank you for joining us. If you're new here to this series, the Financial Wellness Series, welcome, welcome. If you are a returner, then also very warm welcomes to you too. My name is Stuart Paul Duncan, and I'm the Director of Fellowships, Outreach and Programming at the Graduate School at the University of Connecticut, and myself in conjunction with the Graduate Student of Color Association and with several financial institutions and experts around Connecticut have joined together to help provide this series. Obviously, during COVID, things have been more challenging in terms of getting the technology and everything working between our various different areas, but I think we are bringing together a series that's going to be useful in supporting you folks. This comes from a request from graduate students originally, in that they wanted more support on financial issues and topics. So the first two sessions we've had so far have been on budgeting and understanding and managing debt. Today's session that you're hopefully here for is on credit scores and credit cards do's and don'ts, tips and tricks around managing your credit. But we're basically running these sessions every other Friday, so you can pop that in your calendars. And then on the off weeks, I post the video for the prior week, so you can always catch up with a topic that you might have just missed because you weren't able to catch it. But some of the topics that are coming up, loans, loan forgiveness programs, managing money in a relationship, preparing for a divorce, and how that prenups, shared accounts versus different accounts and things like that, investing and investment information and tips, planning for children, preparing a college fund and budgeting, renting versus home ownership. What's it look like to have a mortgage versus paying rent every month? Taxes and preparing for IRS auditing. Hopefully no one actually ever gets audited by the IRS who's a graduate student, but anyone can be, so it's always good to be prepared for something like that. And other topics such as disparities in finances, especially around race and class and navigating discrimination, advocating for financial freedom. All of these topics are things that are coming up in the coming weeks, and we hope they'll be of use to you moving forward. Again, these are all being recorded, they're being uploaded online, they're all captioned, and they all have live interpretation, so they're fabulously accessible for folks, so please feel free to access them down the road. But before we get started, I do want to be a big thank you to our presenter today, who is Judy L. Casperson, the VP Branch Manager at KeyBank. And a big shout out to Sarah, who is our current live captioner on camera, but also Sonia is joining us today, and they'll be taking over from Sarah in a little while. You can also access this stream to see live captioning as well, and there is a post that you can see that I'm going to make in the chat where you can click this if you'd like to see the live text on the screen. That's there and available as well. Otherwise, it's my great pleasure to invite Judy to lead us through credit, understanding your credit score and options. Judy, welcome.
Thank you. Thank you, Stuart. Well, welcome. Thank you all for joining this morning. I know that when it comes to credit, you sometimes have it in a good way or a bad way, right? Even before you graduate college. So we want to give you a great foundation for thinking about how to use credit and why your credit score matters, what it is, and how you can make it work better for you. So if we can just advance, Stuart, thinking about, the few things that we will cover is your credit score, why it matters, how your credit score is calculated, how to maximize and rebuild your credit score if it's already been damaged, and borrowing for one-time versus ongoing needs. So really thinking about good debt versus bad debt. We covered a little bit of that earlier, but we're going to go into that a little more in depth today. So what is that thing called a credit score? Well, a credit score is it's the tool that lenders use to think about how you utilize your credit. Are you someone who responsibly pays back a debt? So it shows that's why lateness matters as well. So it's really all about your ability to repay a loan, how you approach it. Are you early? Are you on time? Are you late? Even sometimes when we're looking at credit decisions, it's like, are they chronically late so they're a lazy payer? Or is it a problem with liquidity and they are overextended? So those things go into how you're thinking about risk when you're thinking about advancing someone credit. But when your scores range from 300 to 850, like I said, these are your indicators to understand what your financial wellness looks like. Next. And so, you know, when you think about your credit score, and sometimes you start and you don't have credit. And if you could advance, please, Stuart. Why does it matter? Well, if you have 0 credit score, you can't get credit. If you have a low credit score, which shows, either that you have very little credit or that you have not managed it in the best way, and your score is lower, or life has happened, as in the pandemic, right? And things out of your control have affected you. Why does it matter? So all creditors will be looking at you. So for a credit card, buying a car, any kinds of loans, your mortgage, and sometimes even your job. So in finance and many other different kinds of careers, it does matter what your credit score is. So, but it not only matters if they will give you credit, it matters how much that credit will cost you. If you have an 850 credit score, then your interest rate could be very, very low, even 0%. But if your credit score is 600% or 600, then your rate might be 4%. So there's a huge difference in and so that equates to the risk that the company is extending when they're giving you credit. So how do you find out about your credit score? So right now during COVID, because so many people have been affected by so many things, really you can get it once a month at freecreditreport.com. But normally you can only get it once a year for free. And there are 3 credit reporting agencies. And I'm trying now, as they're all blanking out of my mind right now, but there are 3. Experian is one of the top ones that is utilized. So that's sort of what my go-to would be. And you can go there and look at your credit score, which I highly recommend, and see maybe there's something that you didn't remember, a bill out there with a dentist or a doctor or anything that is adversely affecting you that you never knew about. And so it's a great way to be able to go and assess and look at, how would you be viewed when you're thinking about going out and asking for credit. So, your credit score is calculated in many ways. If we can advance to the next screen. It talks about your payment history, right? The record of how much of your bill you pay each month and whether you pay on time. So that's when we talked about, paying more than is due, not paying the minimum. Because the minimum, if you're paying the minimum every month, that says that either you're choosing to carry that balance, you're unable to pay it off in full, and you're also going to pay more for whatever that is along the line. And I'll tell you a little bit more about that later as we look at calculators. So if you think about how to maximize or rebuild your credit score, so paying your bills on time will make the lender view you more favorably. I use online banking, so all my bills go out every month on time. So whether I'm traveling, doesn't matter. I put the minimum for everything in there, and as I use my budget, right? And I have everything go out automatically before their due dates. If I want to pay more, I can go in every month and tweak that amount or set a recurring payment. I can do all of those things within online banking. And that's one of the great things about that, is that you don't have to order checks and you don't have to pay for postage. And sometimes they're sent electronically and they arrive there immediately. And with that, the other part that's great about that is that the money comes out of your account instantly. Sometimes when you write a check, right, you don't know, so you have to wait and keep the money in your account until it gets paid, right? You have to think about that and not to overdraft. But if you do online banking, everything comes out of your account, it goes to and so it's a guaranteed payment, which is great, and vendors really like that. You can also have them come into your account and do automatic payments that way. And sometimes there is an interest rate adjustment for that. You get a 0.25% discount on your interest rate if you set up automatic payments. So, when you're out and about and everybody's asking you, would you like this credit card? Would you like that credit card? Credit inquiries, each time somebody looks at your credit, it's called an inquiry. And inquiries are kept for 25 months, a history of that. So if you're looking to purchase a home, if you're looking to make a bigger purchase, you don't want to have many credit inquiries, because that could say two things. Maybe you're indecisive about where you're shopping. You are not able to secure credit, so you keep going to different vendors, or that you're trying to get a lot of credit because maybe you don't have the funds to pay for your lifestyle. So that's how those things are looked at in many of those ways. So, like I said, monitoring your credit is really a great tool, especially now, to be able to get a hold of, see where you are and see how you can repair it. And of course, financial professionals are here to help you. It's part of what we do, and it's not something that we charge for. It's something that we do to help you stay financially well. So let's go to the next slide. So how is your credit score calculated? So it's, I think I skipped that. Sorry about that, guys. Going back. So now we're on how is credit. So the credit score is calculated. We did that by your payment history, paying your bills on time, your inquiries, and how you monitor credit. So if you open many different accounts, then you might think sometimes I should have, let me get 5 different credit cards for only $500 each. And then you max them out, and that shows that you have utilized more than 50% of the credit that was extended to you. So the more that you have can be a positive or a negative thing, right? If I have 5 credit cards that have a balance of $5,000 and I only charge up to $1,000 on each one of them, that's viewed better than someone who has a credit card for $1,000 and utilizes the $1,000 of that. So full utilization makes your credit score go down. So that's why you hear about people who are paying their credit cards off every month. They have higher credit ratings because they're using their credit as a tool, and they don't need it in order to live, right? It's when you use credit as a tool. So think about credit carefully. When someone asks you, do you want a credit card? Think, do I need it? Do I have a credit card that will do all these other things? So I know I've told this story before, so those of you who are repeat will hear it again. When our daughters were in college, I used really one major credit card. I used it for everything for them, for their travel, gas, whatever. And at the end of their time in school, I had enough points to go round trip for 2 people to Italy. So that's when I used it as a tool, right? So I didn't have 5 different credit cards that were giving me, cash back here, points there, because it's the thing that made most sense. Now I have other credit cards, I just wasn't utilizing them in the same way. If we could advance. So thinking about, the different ways that we can help, right? We, at KeyBank, we do financial wellness reviews. It's not something that costs you. It's not something you have to be a client of the bank to be able to have a benefit of. But we go through and talk about all of those things and how you can really minimize the impact that your credit rating is having on you. Or, so one of the things that we can do also is thinking about when you have, so if you don't have credit, we have ways of starting that. So you can start with one of the best things to do is start with a secured credit card. So a secured credit card is a credit card that is secured by a savings account. So you put $500 in the bank. You can get them from as low as $300, but $300 you put in the bank in a savings account that you cannot touch. It's secured by a credit card. So you have the savings account, it's still your money, you can see it, but you can't touch it. You get issued a credit card that has a $300 limit. You are able to utilize the credit on that. So it's a revolving credit as a credit card. So a credit card is like a line of credit, a revolving card. So it does a couple of things for you there. You can utilize it. You can spend $150, $300, you pay it back, and then it's available to you again. That's a revolving credit. So that's what credit cards are. And that's the same as a line of credit when you have overdraft protection on your checking account, or you have something that is secured by a home or other dwelling. So when you're looking at that, you'll be issued a card, your credit card, and after a year, they'll review it, and sometimes even 6 months, depending on how well you pay it back. So if you use that card and say you charge $150, and then at the end of the month, when you get the bill, you pay $150. That shows that you are managing it very well. You are not extending the full amount of the credit card, and you are able to pay it off. It's even better if you only use $75 of that. So staying really under 40% usage, right? The least you use a month of the credit that you're extended and pay it off, the higher your credit rating will go faster. So it just shows that you really don't need the money. It is a tool, and you're using it responsibly as it is intended. And so if you're thinking about that from that perspective, that's a very healthy, place to be from there. And the next slide, Stuart. Oh, yes, do we have one? Okay. So when we're looking at thinking about even when you're going to get a rental, your credit rating is viewed then. So if you have anything on your checking, an old checking account that you have not paid off, if you have any credit cards, you just go to your credit report and start working there. There are professionals that will also help you with that to help clear your credit reports, but usually that's a fee. But if you can do it yourself and do some of the legwork, and we can help show you how to do that, then you don't have to pay all of the extra fees to have somebody clear up your credit when you can really do it yourself. And so when we're talking about what are your credit options, and I'm sorry, making this, sorry, there we go. So when we're talking about what kind of credit product you need, so we talked about how you need to access the funds. Is it a one-time thing, or is it for an ongoing need? So when you're buying a car, right, you're going to borrow money, it's going to be a one-time thing, you're going to pay it off, and then you're going to move on. So that is something that would be secured by a loan, not a line of credit, because you want that amount to be fixed every month so that you can manage your budgets and you can go from there. So again, your credit rating determines what that payment will be. But that's how you determine, what's next with that. And then do you need, your fixed payment, and you think about what your repayment schedule will be. So how much that payment will be will reflect on what your debt to income is, right? So when you go to a car dealership, and this is one of those tidbits, if you haven't purchased a car yet on your own, you go there and they say, how much can you afford? That's not the question. The question is, how much do you want to spend? You get to determine how much you want to spend. Don't let somebody tell you what car you can afford because of how much money you can pay a month. The best thing to do is you go in, you know how much you can pay, you're negotiating the payment, the price that you want for the vehicle. And then, because they're going to make any car fit to whatever payment you decide that you can afford. That is, the biggest mistake that people make when they're purchasing a car. You want to go in, you want to know how much you want to pay for the car, how much, you're willing to, and how much you want to negotiate that rate down before signing. And then you decide at the end, after you've negotiated the price, then you determine what your payment will be. And then hopefully, that fits into your budget because you know going in. So, but the moment that they say, how much can you afford? You say $400 or $300. They're going to make sure that they find something that fits in that for you, but that isn't necessarily the best thing for you. So and a vehicle loan is almost like sort of the first level of a collateral loan. So that means that when you have something of value, that is you're borrowing against. So if you don't pay for your car, right, the bank can take it. They can repossess it. So it's sort of the security for being able to borrow something. That's why you can borrow then any, $50,000, $20,000 on something like that, because it's something that still has value. If at any point in time you don't pay for that, it can be taken and sold to pay off the debt that you owe. So what's the other kind? What's installment payments? What else is that used for, right? That's used for your mortgage. When you purchase a home, it's secured by a dwelling. And when you have that and you have something that's secured by a dwelling, and you pay your home down, right? You pay that mortgage off, then what becomes available in that is the equity in your home. Your home is worth something. It's sort of like money in the bank. So people then sometimes take out a line of credit on the collateral of equity that they have in their home, and that's called a home equity loan for revolving credit, or a home equity line for revolving credit, or a home equity loan if you do something as an installment loan that you know that you have a fixed cost. So say you wanted to add a pool to your home, that is something that you would go in and you would get a home equity loan for, so that you could pay that off in installments usually, and not just the whole thing at once, because if you had that in savings, you wouldn't need the loan. If we could advance, Stuart. So these are the things that we were talking about, just some examples of those different types of loans, and thinking about how you can secure them. So one of the things that we also do is if you get a vehicle loan in advance, so that's something that we do as well. Not everybody does used vehicle loans, but if you got a vehicle loan in advance, or you decided that you were going to buy a car from someone personally, you could come to the bank and get a loan on the vehicle and not have to go through the dealership all the time. And then that would help you to act as if you were a cash buyer. So then you could negotiate your price even better. But sometimes those rates are higher. Full disclosure, sometimes the lowest rates are going through the dealer when they have the 0, the 1.9, 2.9 right now. That's your best bet. If we could advance, please. So we talked about home equity, lines of credit, using that from your home. Rewards credit cards, we talked about that. But so rewards that you can get from credit cards are travel. You can have merchandise cards, so it gives you access to a rewards center where you can buy gift cards from everything from Macy's to Visa debit cards, or restaurant debit cards, or restaurant gift cards. Using that as a tool, you use your credit card all year. Come holiday time or pamper time for yourself, you go and cash those out and go on vacation. There are lots of benefits there. Personal lines of credit, that's the things that would be like your overdraft protection is a personal line of credit. There are also unsecured loans that don't require collateral. That's a personal line of credit or a personal loan that you can go to the bank and get, but we're talking about lines of credit now. But you can go there and get a line of credit that enables you just to have access to some emergency funds as you're building your emergency savings and you're on your road to better financial health. Low interest credit cards. Sometimes if you have a credit card and it's a high interest rate, one of the ways that you can use a lower interest rate or a zero interest, so one of the reasons to switch a card might be because you can do a balance transfer, and that enables you to save money and have a 0% interest rate for a set amount of time, usually 6 months to a year, that then maybe allows you to save some money and pay your credit, put more money on the principal amount of the loan, and then allows you, so then it helps you to get out of debt faster. Next. So when we're looking at those options, thinking about where this has taken us. So one of the things that I was also sharing with Stuart was, managing in this pandemic has been a very difficult thing for everyone. And so the things that we have learned, the things that you can do thinking about managing in a crisis, managing your money in a crisis, what are the things that you can do to make sure that you come out whole on the other side, or at least with an awareness of understanding that where what to do with your money, how to make it work for you. Use allies, use those of us, we're not all experts in your fields, right? We're all experts in our own field. So let's rely on each other to help create a basis of financial wellness. And so one of those things that you would do, you're going to review your credit history. You're going to thinking about the 50-30-20 budgeting, utilizing some of the tools for that. We talked about EveryDollar, which is one of my favorites. We do have tools on key.com, which again don't cost anything to look at. And there are financial calculators out there that are going to tell you how much you're spending. So I'm going to just give you a couple of examples. So say you have a automobile loan, right? And you have a 5-year term, 60 months is 5 years. You have 48 months remaining. Your loan amount was $15,000 and you're at 5.19 interest rate. Your monthly payment is $284.38. If you pay $100 more a month, it shortens that time period by 1 year and 1 month, and you save $379 in interest. So, when you think about utilizing, that extra payment, paying it off sooner, and because people were getting into so much trouble, when you get a credit card now, when you get your credit card bill, it tells you if you pay the minimum, this is how long it's going to take you to pay your credit card off. And if you pay a certain amount, you can pay it off in 3 years. So it really gives you that information to help you help yourself in thinking about how to budget differently. The next thing is how do you start establishing some healthy habits not to get into trouble with credit? Set up alerts. So set up alerts in your phone so when your balance gets low on your bank account, it will text you and tell you, or send you an email to tell you what your bank account is, or when your debit card or credit cards are used. You can have little reminders of that. Also thinking about setting up automatic bill pay, make online banking your friend. Also thinking about looking at what your overall goal is going to be and what kind of credit is going to be helpful for you. And we'll talk later about how student loans will impact you and what we can do to also make that. And that's sort of, it's a challenging debt, but it's also a good debt because it's going to get you where you want to be in life and get you to those higher income levels so that's the loans. Remember, good debt and bad debt. That's it's not a great debt, right? But it's not a terrible debt. It's the debt that's going to fuel your projection into the future. Credit card debt can be viewed if you're having a lot of credit card debt, that's bad debt. When you're utilizing more than 40% and you're not paying it off every month and you're carrying a balance, that's going to take your credit score down. The other thing within your banking, you can look to see what your credit score is. So it tells me every month or every quarter what my credit score is. And that's also a tool that you can turn on within your online banking so you can watch it go up. Or if it goes down for some reason, you can go to your credit report to see what happened. So this is how you're, again, telling your money what to do, not being a victim of what your credit score is, and being able to manage it to understand what your buying power is. So once you get to 650, is where sort of the minimum that you want to be. That's when you can really borrow money, and your credit's good. It's not, it's sort of fair. It goes into good when you hit 700, and above 750 you're going into great, and 800 is excellent. So you're getting into those ranges, and really being able to utilize that for yourself. So I'm sure I saw some questions come along, Stuart.
Yeah,
Is
absolutely brilliant. Thank you so much, Judy, for that wonderful presentation. Folks, we're going to enter into our question